So today we have with us Michelle Bromley. Michelle's Head of Strategy and Advice. This is part of us sitting down, talking about what's important to clients, what they should be planning for, start of our calendar year 2020, good time to make some solid plans and talk about how we can make a material difference to achieving our aspirations, our goals. So welcome Michelle, and let's start talking about how we can add value for our clients.
Thanks, Simon.
So Michelle, start of 2020, lots of conversations taking place. Clients have been away with family, making plans for the year ahead. You're talking to not just clients, but you're also talking to our advisory team in your capacity of Head of Strategy and Advice. But let's try to simplify it for everyone. Let's say 2020, what do we do? What do we think about? What's important? Now, what are you talking to advisors and what are you talking to clients about? Just give us a bit of a feel.
Yeah. So in both cases, I'm saying to people to take an overall view and determine really what is your 2020 going to look like. So clients should sit down with their advisors and they should reconsider their goals and objectives. And they should break down that longer term plan into smaller or shorter term steps to take in 2020 towards achieving that desired outcome in the longer term. As part of that discussion, we need to consider whether there have been or are likely to be any changes to the client's personal or financial circumstances that we might need to take into account in adjusting their strategy for, such as, maybe there's been a change of employment with an increased income, or maybe they're actually in their last year of employment and they're looking towards retirement, so we need to do some extra planning there. On the investment side, as our Chief Investment Officer formulates his market view for 2020, advisors are going to be really looking at portfolios and considering what adjustments need to be made to position those portfolios for the next 12 months.
Yeah. And the portfolio position piece is very important, and with the market at a very high place as we speak today, and our motto has always been helping our clients to protect their assets and build their wealth. It is just an opportune time to make sure that the clients fully understand the risks. You're getting that right balance between income and growth, and you often talk about asset allocation. Just give me a bit of a high level on that as well.
Yeah, so we've got a set of goals that we've set with our clients around what they need from their portfolio. A lot of our clients are retirees and they're focused on providing themselves with an income to meet their living needs. So that'll transpose into an income and a growth objective to achieve from the portfolio. And we need to consider those objectives in light of where we are in the markets currently, and we agree that the markets are highly valued. We've got a bit more of a conservative view on markets, which we've held for a while. So we've been making tactical adjustments to asset allocations and reducing some exposures to equity markets, increasing exposures to higher yielding markets such as direct property, and in that way we're working with clients to meet those income objectives while still having some longer term growth aspiration as well.
Yep, all makes complete sense. Thanks, Michelle. So Michelle, must-dos. The thought process is often that a small number of things done really well make the most material difference. So in your mind, what are the must-dos for our clients at the start of this year?
Look, I think that the basis of any good financial plan is around cash flow. So there's 3 key points, which would be to make sure you've revised your budget, regain control of expenditures, and determine how best to use any surplus cash flow. You need to really make sure that you've got some surplus cash flow and then think about how you're best going to use that. The first rule is to make sure that you're financially taken care of. So that might mean making sure you've got adequate income protection in case you can't work for a period of time. We talked a bit about repaying debt while interest rates are low. Or if you've already got your insurance and debts under control, do you have the opportunity to put a bit more into super, or maybe do some investing outside of super?
That makes complete sense. So Michelle, let's talk about what you think are some of the greatest opportunities for clients at the moment and where would you ask them to focus their attention? And sitting down with their advisor, where do they put most of their thought process in right now?
Yeah, sure. Look, there's a number of opportunities we can consider depending on the client's situation. If we start with the idea about reducing debt,
Yep.
What interest rate are you currently paying on your mortgage? When was the last time that was reviewed? Could you benefit from renegotiating rates with your bank, or maybe talking to a broker about really refinancing that loan and making some savings that way? One of the big opportunities every year is that there's a new set of contribution caps each year that you can access. In particular this year there's been some changes for older people who are in retirement for the first time. So as of 1st of July 2019, anyone who retired and they're 65 or 66, they met the work test last year and they've got less than 300,000 in super, they can actually continue to contribute to superannuation this year, even using the bring forward contribution rules or the catch-up rules as well.
Okay.
That's proposed to be extended from 1 July this year.
Right.
So that people who are 65 or 66 can contribute without having to meet the work test or that $300,000 cap. And that's to realign essentially with the age pension age of 67.
Okay. Yep.
Retirees over age 65, if they're doing a downsize from their home, they can also contribute up to $300,000 per person, provided they've owned that property for at least 10 years and get at least a partial capital gains tax exemption, so they've lived in the home for a period of time.
Right. Okay.
On the investment side, there are some really exciting opportunities opening up. So we've developed relationships with some specialist firms to bring residential property opportunities to our client base for younger wealth accumulators all the way through to mature wealth holders. And for those who have more significant amounts of wealth, there are some more specialist mortgage style funds that have a higher yield, obviously with some higher risks, but are for people who are looking for investments beyond the traditional asset classes.
Okay, wow, there's a lot there. I think probably the main message I take away from that is that sitting down and talking about how those opportunities relate to my specific circumstances is going to be different to someone else. So having a conversation with your advisor early on in the year and just making sure that you don't miss out on some of the benefits from these opportunities.
Yeah, absolutely.
So Michelle, let's talk a little bit about risk and how best to mitigate it.
In my view, the biggest risk is being complacent and doing nothing.
Yep.
Successful clients do something. An example of where you might fall down is not having adequate insurance to cover you if you can't earn an income, and your advisor can sit down and assess with you what level of income protection, death, TPD and trauma insurance is right for your circumstances.
Good point. Yep.
Failing to take control of your finances, not taking control of your discretionary spending and not creating that surplus income is a big opportunity cost, because every dollar that you spend, interest that you give to the bank for example, is a dollar that you're not investing, and therefore you lose the opportunity cost of creating those returns into the future, compounding. Sticking with the investment side, being too conservative and being reluctant to invest cash sitting in the bank, especially at current low interest rates, that too is an opportunity cost, failure to create returns into the future. On the flip side, being too aggressive, especially at the current point in markets where we do see that markets are highly valued, has significant downside risk, especially if your investment time frame is short. So what you should do is set an asset allocation that's aligned with your goals and objectives around income and generating growth for the future, and make sure you stay aligned to it.
So Michelle, talk us through what are the key takeaways? What are the things that you really want everyone to walk away with and they go, right, if I tick these boxes, I'm going to be in the best possible position?
Sure. I think that the key actions for clients to take are to revisit their goals, take control of their cash flow,
Mhm.
Make best use of their surplus income. Ensure that risk is mitigated.
Yep.
Position the portfolio for likely market conditions.
Mhm.
And keep an open mind around new opportunities.
Great advice. So Michelle, some fantastic points that you've made today. I think that there's a lot of key takeaways for not just our existing clients that we work with on a regular basis, but anyone who would like to come and meet with us. I think no matter what you're doing in life, having a plan and regularly reviewing it, it's pretty rare that you don't get a better outcome if you're being considered in your approach. So I think you're going to help a lot of people with the advice that you're giving, and so thanks so much for your contribution today.
It's my pleasure, Simon, and I would just encourage anyone to give us a call and start that conversation now.
Fantastic, thank you.